Good afternoon and welcome to this week's edition of Halftime Talk. We're thrilled to be having back with us Mike Muller, the head of Vitol Asia, to take an outlook on the fourth quarter, with just days away now to the last quarter of the year. It's been an incredible year to date. What will the fourth quarter bring? And there's no better person to give some insights on that than Mike Muller. Welcome.
Thank you very much, Sean. Great to be here.
I suppose the good news for 2022, Mike, is that all things being equal, no black swans. That's a big statement these days. But nonetheless, what are some of the reasons you think we should be confident about holding on to the gains of the first three quarters of 2021 into the fourth quarter? We're in the 70s now, but we should hold these gains.
Well, markets tend to clear on the margin at the level that the market is comfortable with. And if we start with oil, it has established a pattern where it's traded from mid-60s to very high 70s in the last 3 to 4 months, and has spent significant amounts of time looking comfortable in the low to mid-70s. What's the other feature about it is that we have a backwardation, which is pretty much the shape of the market that OPEC Plus set out to accomplish at the height of the pandemic, when they had to take such an astonishing amount of oil off the market. And since that point, they've very successfully managed to manage the market and manage expectations in terms of how they've played it. And of course, the fact that they're meeting on a monthly basis keeps the market guessing a little bit, but the underlying philosophy is pretty clear. And it has been augmented as and when needed by the Saudis taking incremental oil off the market, and by a pretty disciplined approach towards all members. OPEC Plus is a very big club of participants, making good on overproduction and coming into a compliance which has been publicized at levels, of course, that may suit the playbook, because if you factor in countries that cannot produce at their pre-pandemic levels, such as Venezuela, you get some very nice percentages. But that said, the bottom line is very simple. We have OPEC Plus gradually putting 400,000 barrels per day back into the market on a monthly basis at the moment. And that is
struggling to do so, it would appear, in certain cases, given the dynamics that in August they didn't meet that number.
Indeed, there have been countries that are already at their capacity, if that isn't the same as the pre-pandemic baseline level, because of natural decline. And of course, we mustn't forget that we're still coming off the back of a low price cycle and a economic wobble, let's call the pandemic, which has not exactly been conducive to investment in not just mega projects that are 5 years away from producing, but also the sort of near field infill drilling and enhanced production investments that are required to keep mature fields producing at current levels. So those natural declines have been kicking in and biting in certain provinces, certainly in various deep water parts of West Africa, and certainly in the North Sea, where it's part and parcel of the normal way of things. Yes.
We saw OPEC Plus report in September earlier this month, and it was quite bullish, I thought, in the sense that it didn't revise down its demand recovery forecast for 2021, 6 million barrels a day on the year average, which means the fourth quarter from their perspective will remain quite bullish. Your thoughts on the OPEC report? Any surprises for you?
Not really. We need to put this in the seasonal context. Q4 is always a quarter where demand is greater than Q3. People often get distracted by the summer driving season, but the much bigger feature, of course, is winter heating and the general seasonality that you see. And the baton gets passed from the US to Asia, which makes up most of the demand growth month on month and year on year for this part of the year, for Q4. And I distinguish between month on month and year on year because year on year growth is all in Asia. When there's talk of peak oil demand in certain advanced OECD economies, Asia is definitely still looking ahead. And the month on month is self-explanatory. You have places like Japan, which traditionally consume more jet fuel, heating oil, and greater distillate consumption. And of course, weather-related higher rates of consumption for heating. So Asia will be pulling a lot of oil from the supply system, from inventory, and I should expect from the West, which is a structural thing now. The front haul in global freight markets is west to east. A few decades ago, it was Middle East Gulf to west, of course. Yeah.
When you consider the outlook for the fourth quarter and for that Asian demand, you obviously have to think of China. And the question I have is, there does seem to be a willingness in China at the moment to sacrifice growth for some structural policy changes that they've been making, some around climate and carbon emissions and others around other types of economic management. But nonetheless, there does seem to be a tone that at the cost of economic growth, we're going to make these changes. Your thoughts on that as a thesis, and B, what kind of impact it could have through the remainder of the year?
There are so many strands to answer that question. I mean, the government has clearly had an impact on certain segments of the what we would call the current new economy, in terms of clamping down on the profitability of online tuition firms, the Evergrande property company haircut, let's call it. Intervention in large-scale online retailing platforms, proposals that aspects of Alibaba should be split up, and so forth. And for the most part, if the apparatus, if the government in Beijing says that's what they wish to do, the companies fall in line and they do so. Closer to home in the commodities and energy sphere, you've had much bigger headaches for the Chinese decision-making bodies in Beijing in other commodities, I would argue, than is the case in oil. But we have seen a rather substantial rise in utility fuel prices. And by that, I mean LNG, which is marginal supply for most utilities. But China's seen a voracious growth and appetite, if I can use that word, in terms of its imports of LNG exceeding all expectations this year. And that is underpinned by extremely strong coal prices, where we've seen prices in the mid-hundreds per ton for lower quality grades of coal and domestically produced coal variants. And at the same time, domestic production has been impacted by weather, by safety audit impositions, and potentially also production problems. And that's really been stealing the headlines from oil, which of course has also been the subject of many headlines. And the two big recent pieces of handed down decision making from Beijing have been number one, release of SPR or CPR. But I would hasten to add that it shouldn't be seen as a permanent release. Chinese demand is growing. SPRs tend to be viewed by governments as stocks in days cover, and therefore they need to keep building SPR in China because China is very much still growing as an economy and in its consumption of oil. But nonetheless, there's a release which was initially mooted to be just above 25 million barrels to be released in Q4. It went a little quiet when oil prices dipped, and we had a couple of in relative terms, crashes from 70s into the high 60s about a month and a half back. And they've come to the fore again, but there's still a lack of clarity on exactly what the nature of these will be. But it does seem to be the case that the SOEs that hold these inventories have also got a mandate to replenish them at some stage in the future. So these stock releases are temporary.
They have indicated that their days cover, as you mentioned, they were for many years at 90 days, generally regarded as being their days cover. Now it seems they're kind of migrating towards 100 last year, at least. Where do you see that now in terms of what is their kind of target?
Quite honestly, Sean, I don't know. The policy is clearly to have security of supply and to have it in the right places, but also to task the large SOEs with the responsibility of managing it. And as most progressive governments are doing, managing it intelligently and using it on the margin for commercial balancing purposes also. I mean, there's been less coverage of the typhoons in Asia than the hurricanes in the West, but this Changfu typhoon, which was threatening to hit the Shanghai area, but then took a turn towards the northeast and is now heading towards Korea, did close a certain number of flights into Shanghai. A colleague of mine was meant to be flying there yesterday, and his flight was put off. So there are impacts which require balancing at times also. Not that there's ever been an Ida in China, but there is the prospect of that. And China has suffered extremely wet weather, which has disrupted a lot of infrastructure work as well. So there's a bit of a balancing act to be taken here. I would contend, however, that if oil prices had corrected and stayed in the 60s, there might be less talk of this. So there does seem to be amongst the trading community, some speculation that NDRC and the Chinese government is seeking to not intervene, but to manage markets and have a very commercial attitude towards releasing stock at a price that makes sense. If a trader was describing it, they'd say taking profit, and then replenishing at lower prices. And of course, they had the fortune to have filled a lot of the recently constructed SPR during the pandemic, which made good economic sense.
I suppose the replenishment question, or the question of forward cover, what number of days they're comfortable with, may give some guidance as to what they might be willing to buy in the fourth quarter. Is it a structural decision or is it a commercial one? If it's structural, perhaps they'll replenish. If it's more commercial, maybe they'll hold off if prices are chunky. Let's just...
Sure, if I may, I think the decision is always to replenish, because I view SPR releases as not quite price neutral, because of course they impact prompt supply versus the future. But then in the longer run, I think they all need to be replenished, because otherwise a government is saying that if oil prices keep doing what they did a decade back and they moved into the 100+ range, they let it all go for commercial reasons, and then they have less cover. And by definition, high oil prices normally mean there's a geopolitical shortfall or problem somewhere, which is the exact reason why people want to have strategic reserves.
Let's just touch on LNG a bit, Mike. Obviously, we're seeing now kind of, although we're kind of an oil program in some regards, we are interested in all of the other pieces that impact and the correlations. And LNG clearly at these price levels that we're seeing ahead of the winter in Asia have an impact right across the energy matrix. What are your thoughts for the outlook for that in the fourth quarter? How could it disrupt other things?
Again, that's an awfully hard question, making those forward-looking statements. But what we have
clearly, in some ways, it could displace higher sulfur fuel oil. Could be used instead of LNG gas for power generation, or coal in China might come back in more. Any things like that?
That's exactly where I was going to go with my answer. But first, let me say that what we've seen is a very counter-seasonal price jump. I don't think the word spike is appropriate. Spike is what we saw in January of this year. But this seems a lot more structural, a lot more permanent. And it's underpinned by production issues around the world, East and West, concerns that are underpinning the supply of natural gas into Western Europe, centering a lot around speculation about Russian increased domestic consumption and ability to get gas to Europe. The US market has finally caught up as well. Henry Hub always trades at a much, much lower level, and therefore is the cheapest source for LNG to be shipped elsewhere. But Henry Hub has moved in broad terms from 250 to 4+. And of course, with TTF, the European benchmark, sitting in the very, very close to $20 per MMBTU, and JKM having pushed, not in the prompt now, but in the early winter months through and above 20, that made it obvious that there was space for the US benchmark to move up if that made sense. And I guess the Hurricane Ida outages, water related, which did affect some gas and gas fractionation capacity in the US as well, may have given the pretext for that to happen. So coming forward to your question now, clearly we have LNG trading at a price on a calorific adjusted value that is higher than alternative fuels. So you need to look at those sectors of the economy which can switch fuels. And there are several that one looks at. But the big problem is that largely for ESG, for environmental reasons, a lot of the capacity to switch has been dismantled, turned into scrap. So in particular in the Western Hemisphere, the number of utilities, power stations that can interchangeably come onto the grid and burn the cheapest of the alternatives, which is fuel oil, is less. And therefore, the obvious place to go instead is coal. And of course, there are certain economies that don't wish to do that and are therefore legislating against it. But others are. And even in Europe, I believe there have been days where on the margin, coal-fired power has been called for to avert power spikes. Of course, power spikes were famously behind the spike in LNG prices back in late last year, trading January and in particular February of this year. And that was because of shortages in Japan, where aggregators, resellers, found themselves overcommitting as prices moved up. The same analogy had with SPR before, and then they were caught horribly, horribly short with the dire financial consequences that brought upon it. And that, to my mind, has probably seen them take a slightly more cautious approach towards having a little bit more stock up their sleeves for this coming winter. And I think the same goes for Korea, but I do not think the same goes for many other parts of the world. And people are concerned about inventory and cover for Europe in particular. And that was illustrated when Amos Hochstein went across to Europe and had a bit of a chat in the context of Nord Stream 2 discussions. letting passing comments go to the media that he felt that maybe some quarters in Europe do not quite realize how much of a gas supply threat exists should gas be required from Russia in other parts of the world or for other purposes. Because Russia does now have LNG liquefaction capacity, and it does have pipelines to Asia, and geopolitically that resonates with hardliners who wish to portray Russian supply as a swing supplier, as a potential threat to prices. So back to switching, Sean. Every consultant out there has been getting out their sort of notepads to see where the switching can occur. And the obvious sector is the power sector. It's from LNG to coal. It's from LNG to liquids where possible. In some places, it even makes sense to get fuel into generators. Some sectors of the economy, like industrial in the C&I sector, can burn naphtha as an alternate fuel. Some IPP power stations that burn natural gas, piped gas or LNG have backup tanks which contain, these are the 1990s generation units, but some of those old-fashioned turbine frames can burn liquids interchangeably. They ought to be doing so. And then there is the old LSWR market for burning in places like Japan, where there is extremely limited capacity to switch because a lot of that is either out of commission or doesn't have a permit. And in some cases, it's not economic because, of course, refineries are tugging away at that very same feedstock in a very strong fuel market. But
and
LNG
China?
LNG prices have underpinned fuel oil in a very strong way, and the bottom of the barrel has seen a big surge in recent weeks. China, yes. I mean, obviously in China, your basis for power generation is very much still coal.
Yeah.
So the higher domestic coal prices would tell you that it's a bit of a squeezing of the balloon going on, I guess, where they're caught between a rock and a hard place in some parts. There was a rather interesting one. Sorry, jumping to India quickly, but when it comes to coal burn, India is also very front and center. And in terms of days cover, many coal-fired power stations in India are way below their minimum operating inventory. Some are down at 3-5 days, others at 10, 11 days, against a normal comfort level of maybe 14. So there's a directive from the Indian ministry for those power stations to have excess inventory, to stick them on the rail system and help replenish stocks at power stations that were otherwise going to run dry to avoid brownouts and blackouts in the coal-fired space in India. As for China, yes, I mean, a big coal-fired sector. I don't have any anecdotes, Sean, that would lend to this, but I'm sure.
I'm just wondering where their sensitivity will be around the emissions. They do seem to have a particular heightened sense of this year. They're trying to tackle the carbon picture, burning more coal through the winter up because of high LNG. Is that an option or not?
Yes, I think you've onto a point there, and that brings us back to the China question I hadn't fully answered earlier. The second thing the Chinese did, of course, is issue quotas, import quotas, which refiners in China need to comply with. They can't import crude unless they have a quota, and there seemed to be a rationing of how much crude the total Chinese refining system was able to import, and the brunt was borne by the independent sector, often referred to as the Shandong teapots, which clearly didn't have enough quota to import, and there was immediately people jumping to conclusions that this was the beginning of the Chinese government starting to impose decarbonization initiatives and starting with paring back that private sector and forcing the economy to seek alternate ways. But many of these refineries have been set up as specialist refineries. Many of them are bitumen plants, some of them are simple processing plants, and others, of course, highly complex, of the sort of similar configuration to a typical large Singaporean refinery. Now, the big change that occurred back in, when was it now, first week of September, was that we saw a release of quotas for the very newest of the large independents, a refinery called Shenghong, who are set to go a month after next in November. And that refinery was issued a tender to import 2 million tons, which is roughly commensurate with their capacity of 320,000 barrels a day. And bearing in mind that normally refineries start with a gradual ramp up, that was perceived as generous. And then additional import quota was also given to the largest of the independents, known as Rongsheng of Zhejiang. And there is a feeling that maybe there may be more coming. And this was widely expected to be a signal, a trigger for the softish front end of the crude market to see an uptake of spot oil, an oil carryover from September to October, October to November. And indeed, that's what happened. So Chinese buying through the first half of September visibly accelerated and gave a fresh wind of hope, I guess, to suppliers of crude, NOCs, Middle East and traders who had been a little bit perturbed about this slow buying pace in China.
Right, we've seen in the earlier months. Let's just, Mike, wrap up looking at the US. Of course, we've come through the hurricane. We're in the hurricane, so he's not come through. Ida has had a legacy of significant impact and disruption for maybe a much longer period than people would normally expect hurricanes to do so. Your thoughts on where US demand goes and supply through the Q4?
The US is very much, as I said, it held the baton in the summer in terms of domestic flights, domestic demand, lockdowns being a thing of the past. And of course, the US has since seen a resurgence in COVID cases. But a lot of the underpinnings for the stronger summer market were led by US demand in life after lockdown. Of course, Hurricane Ida has taken a big chunk of supply out of the market. I think the last number I saw for upstream production offshore in the Gulf of Mexico, so these are the deep water platforms in the gathering system for Mars, for example, coming into Louisiana, was now below 1 million barrels a day of supply loss. But I think if we toss it up and make some sensible projections using previous hurricanes as a template, it does look as if there'll be 35 plus million barrels of offshore production lost permanently, as companies like Shell repopulate their platforms with expert crews to bring those fields back into the system. And commensurately, of course, you've had issues with power supply and water flooding in certain of the refineries around New Orleans area, which have been which bore the brunt of the deluge that came with Hurricane Ida. And that's typically always a slightly larger number. Louisiana is much better prepared than it was for the most similar hurricane I can draw into comparison, which was Katrina, in terms of levees and defenses. So there was none of the really, really bad flooding from Lake Pontchartrain flooding and causing issues there, alligators and levees, etc. But it does look as if if you toss it all up, the total refining capacity that's out is 45 million barrels a day or thereabouts. And that's 45 million barrels of supply on the margin that had to be replaced by other refineries, because of course there's an impact on demand, but it's nothing like those numbers. When the streets are flooded in a small area outside of New Orleans, life goes on elsewhere, right? So yes, Sean, that slack had to be taken up by the rest of the refining system, not just in North America, but in Europe.
Do you think, I mean, just on the sort of more longer term outlook, but maybe not so, that on the pricing side, on the market side, that we need to start considering a kind of climate change premium in the oil price? I mean, these disruptions, this infrastructure is just not built for purpose anymore for this scale of weather event. We saw in the first quarter in Texas, the ice storm causing havoc with infrastructure that just isn't built for that kind of extreme. Now, Ida, greater force, that the recovery is just a lot longer, and the pricing needs to reflect that.
It is, Sean. I mean, 2021 has been characterized by some outlier weather events. I mean, you do get cycles, El Nino, La Nina. Ocean surface temperatures in the Caribbean have been at unprecedentedly warm levels. So, I mean, if you have ocean surface in places like the Barbados area, which is the kitchen where many of these things start accelerating and becoming hurricanes being 30 degrees instead of 28 degrees, that's a lot bigger convection engine that drives these things. Now, to your question, whether we need to start taking climate impact or perhaps carbon into consideration, yes, there are moves afoot and there are plenty of discussions in our segment, as we all wish to embrace decarbonization initiatives and see whether there's any way of having these embedded in an orderly fashion in global markets. But it's awfully difficult to do so with something that is not quite as fungible as oil. You can't send it off to an inspector to see the quality. You can't measure it to determine the exact quantity and quality.
Well, I suppose my point is more reflective of the market reaction, right? We saw on Ida, the market slowly reacted to the output disruption, not thinking initially, oh, there's another hurricane, a week, everybody back on the decks. But actually the progressive increase in oil price, as it dawned over weeks that Ida was much more disruptive than initially thought.
Okay, I'm with you now, yes. I mean, on that tangent, in a separate discussion we had a week and a half ago, so you suggested that the total outage of 40 million barrels, if you want to call it that, is more than 1 million barrels a day in a month, which if the Saudis had done it as they did when they voluntarily took
January,
the market, had a much greater price impact. And that brings us back to another thing, which is how much is the hurricane premium? Let's bear in mind,
Yeah.
hurricane season isn't over yet. Another
Yeah.
Ida is possible.
Yeah.
We have a hurricane hovering. We had a hurricane hovering over the sort of southern Texas Corpus area, which looked a bit like Harvey in terms of its ability to just linger and drop lots of rain over the area. So yes, there's possibility of more to come, and therefore that premium is definitely in there somewhere. But I do think markets are very accustomed to anticipating hurricanes and pricing in the impact and looking at the relative impact on gasoline versus jet fuel versus feedstocks versus natural gas liquids versus crude. And often it's, buy the concern, buy the rumor, sell the fact. In the case of Ida, the fact was arguably harder hitting than people had anticipated. And at one point, there was a concern that one of the huge nexus points of the Mars offshore system, known as WD-143, had been ripped off its moorings. Now, stuff like that has happened in previous hurricanes. It turned out not to be true. The fact that that didn't send the market shooting much higher than it did has been pointed to by many bears as, look, the market is actually overpriced. But it's hard to say, Sean, because the market prices these things in, just like the market prices in expectation of Chinese demand growth and winter weather. I
suppose ultimately the biggest sort of overriding factor, of course, is the OPEC plus managing supply, but also the US economic recovery this year has been, beyond perhaps the best expectations, even though it's moderated in recent months. I'm wondering, just looking to the fourth quarter, let's sort of wrap up on this point, US economic growth as an engine for the global economy, as an engine for the oil price above 70. You're confident that sustains through the coming months?
I think so. I mean, a lot of people talk about the impact of tapering, overheating, inflation concerns, but the bottom line is that economy looks in reasonable shape in terms of, from my very parochial interpretation and perspective, which is, what does it mean for oil consumption? What does it mean for LNG demand? What does it mean for investment in the Permian? I think the world is normally looks at supply and demand in pretty equal measure, but right now it's really all about the supply side of the equation. I don't think there are too many economic scenarios which are going to see the demand needle move that much, be it China, be it the US, be it the rest of the world. The one we're all watching still is hopefully the tail end of the COVID lockdown impact on certain ASEAN economies, which have seen a late wave. Vietnam, Thailand, Philippines, Malaysia, still pretty bad. But if you compare it to the West, I mean, you have close to 2% of Americans and United Kingdom residents have COVID right now, according to the official statistics. Now, in some countries, you don't get quite such good quality of data, but the highest percentage country in the whole of Asia, when I looked yesterday at the Worldometer stats, was Malaysia at 0.7%. And there are hardly any other Asian countries that are at more than 0.2%. That's 1/10 of the incidence in the UK and the USA right now, which is why I can't travel to those countries, because I then have to quarantine going back to Singapore. But the point I'm driving at is I think once the Asian tiger economies get up that vaccination curve, and they're on the vertical part of it now, and economies like Australia, by the way, which are taking a great deal of the headlines, it's really about supply. And it's really about what is the shale response. So it's about how much will the incremental production be, and it is going to be incremental from the Permian. And we mustn't just look at drill counts and rig counts, because there's a whole new dimension, a whole new paradigm there with the assets having moved from hedge fund dominated investment types to oil major controlled, and productivity per well and programs and disciplined deployment of capital and requirements to go after a certain IRR. And there's a wide divergence in views on how much US production is going to go up, but there's no question that it's going to go from somewhere in the low 11 point something million barrels a day for the US wide figure up towards and above the 12 number by the end of 23, and that a lot of that steepness of the curve is going to be throughout this coming year, 2022. The second big influence is the question on Iran. I mean, the views diverge massively on whether Iranian oil, apart from that which is going to China with tacit acceptance that's base load, 600,000-700,000 barrels a day or so, and then all the streams of products and components that are managing to slip the sanctions net because it's not being as rigorously imposed as perhaps might be the case. And that links in with the discussions that are being had with the IAEA over the resumption of the joint agreement. And I've detected that the consensus amongst both traders and consultants seems to be shifting towards a delay in the return of Iranian crude oil. If you take that out of your balances, the bit that's left is simply the equation of OPEC plus putting 400 a day on the market every month and how much demand is being tugged. And I just got the IEA numbers through for Q2. They're seeing a total known and estimated stock change of 2.8 million barrels a day. That's 7 times the current rate that OPEC Plus is putting oil back in the market. And that, of course, has taken inventories way down. And we're approaching very soon the stock levels that we saw pre-pandemic. So mission accomplished, OPEC. And then the question is, okay, but there's so much spare capacity. Oil as an asset class is still pretty unsexy because there's so many other places that are better to go with. And why is oil not such an attractive place to deploy your money? Well, because it's still primarily a transportation mobility linked issue, and we're not out of the woods yet on COVID. People aren't flying internationally as they would, and therefore there are more interesting asset classes to put your money into, agriculturals and metals in particular. So all that investment money is yet to come as and when we get through this pandemic and economies start looking forward as they come out of lockdown. And the big demand chunk that's still missing is aviation demand, international travel.
Last word on the sort of crystal ball surprise that might come in the fourth quarter. If you were reversing and you were interviewing me, I might say, I think there might be a surprise in OPEC Plus's ability to easily add more capacity back in the market, and maybe the market is over anticipating that they have all of this idle supply that could easily be pushed back into the market. What would you think of something in the fourth quarter? Oh, just keep an eye on that.
I could go to so many different places.
I know.
There are question marks.
Events, maybe events, conferences coming back. Maybe that brings us into some new place. I don't know.
Well, I was sad to see that your Fujairah conference has been put off in consultation with the the government into March, but we'll be there in March, Sean. Yes, I mean I can't pick one, but I think we are going to see a world where if the ramp up of US production and of the other non-OPEC fields, I mean Johan Sverdrup, Liza in Guyana and various other provinces, Brazil, doesn't come back quite as quickly. And demand post-COVID does resume, and there's no Iranian crude in the market other than what we see today. Pricing power is very much handed back to not just OPEC Plus, but core Gulf OPEC, which is where the spare capacity is. And whilst many macro analysts will say, yes, there's all that spare capacity in Saudi Arabia, there's some in Kuwait, Iraq, UAE, etc. There is, coming into winter, possibly going to be a realization that this is not enough to give the market confidence that the market's going to be managed in the 65-75 type band.
Right.
And all eyes therefore on where would Crown Prince Abdullah bin Salman like to see oil. Would it not make sense to come out of this COVID response by OPEC Plus, printing 80 plus oil, if I can be controversial, or maybe even closer to 85, 90, in order to put down that marker and having price action there to see what the response is. Because whilst there's been a lot of negative reaction, adverse reaction from many quarters, be it SPR releases in China, be it
and the US.
Biden supposedly calling them, yes, be it Indian stock release. As I said before, all these economies are going to want to put that inventory back at some point in time. And people then start worrying about the effect on the economy at a time when there are concerns about reflation. And what exactly will the dynamic be between core OPEC and those economies that wish to influence where the price of oil is in order to better manage their economies? And of course,
we could go on and on, Mike. We'll be well over our time. We're going to have to edit this down, I think. And you, I know, have other things. Listen, Mike Muller, head of Vitol Asia, on Halftime Talk this week. Thank you so much.
Sean, it's been a pleasure. See you soon. Thanks.